Does it feel like the U.S. policy madness went up a notch recently? Well, our chief equity strategist and economist, John Blank, is here now with me to explain why it has. John, you cite the Fred Index of U.S. economic policy uncertainty as showing that it has. What in that index supports that?
Yeah, Terry. So we need to talk about the U.S. Economic Policy Uncertainty Index. It's an actual index constructed out of the news headlines, that are aggregated out there by the Fed. So it just shows, they really count them up. Literally, they can do that and show you how much the news is reflecting uncertainty. And we've seen a jump to April Liberation Day highs of late because of the Iranian conflict. And furthermore, Terry, Deutsche Bank has put out a taco trade index, which shows when this administration and this president particularly will fold his hands when the pressure gets high enough on that index, which includes inflation, 10-year yields, and the stock market. If you combine all of that, there's no question that this is just a massive overhang for the underlying physical and real economy of the United States and the world, frankly.
And I'm understanding that this policy madness, U.S. policy madness, has some hinge as far as the labor market goes. What's the message as far as hiring?
Yeah, so Terry, we need to talk about hiring because there's been 15,000 jobs a month on a revised basis. So we can count that as signal and not noise for the last year. And that means the United States is effectively contributing zero jobs across a year, across the economy. So why do hiring authorities make no decision to hire somebody in this environment? Because hiring is a multi-year decision, Terry, much like CapEx, putting up a factory was a multi-year decision. Actually, hiring of a full-time person is a major commitment by a company. Health insurance, the long-term, structure, the cash flows, the person has to be paid month to month for years sometimes. So in uncertainty, the hiring authorities tend to scale back because they simply do not want to take long-term challenges to their budgets in the face of unknown consequences for their revenues. So this is the case here, and it does not mean to me that, Terry, it's uncertainty. It's not necessarily how much revenue you get in; it's how much people worry about losing it, and that's a material thing. When people raise their worry, they will stop making longer-term decisions like hiring.
Can we put this on a timeline as to when hiring managers at companies stopped hiring?
Well, Terry, there's two kind of fulcrum points in the hiring decision matrix over the last few years. One is actually 2 years ago when the unaffordability got so much that demand started to shrink. So that was early to mid 2024 in front of the last election, which then put this president in to fix that unaffordability problem. And then the last 14 months, we've seen nothing but more policy uncertainty, unprecedented emergency order rafts of orders, hundreds of orders, sometimes seven or eight a day at times in the early going, which just pelted this economy with uncertainty about their duration, depth, meaningfulness, whatever. And this has been the second round of this, and it's in many ways, Terry, the Iran conflict is the third blow to put on in place in terms of the uncertainty.
Seems as though this is a multifaceted situation with other contributing factors, namely U.S. tariff actions, higher for longer interest rates, and the downshift in consumer demand. How are all of these interrelated?
Well, Terry, I kind of prefaced what I already said with your comments here. I mean, we need to understand, really, it goes back to the aggressive Federal Reserve monetary policy, QE, they implemented basically back in the depths of COVID, the money printing, if you will. It started the inflation spike in the 23-24 period, and then we got into the tariffing in the early 25 period, and then we got into the consequences of this year and the conflicts that have emerged around the world, some successful in their objectives, some uncertain in their objectives. But at the end of the day, since this podcast is about uncertainty, whenever you ramp up chaos and fog and ramp up an unknown consequence for a very broad decision at the federal level, people will pull back their hiring, their spending, their investment, and in general just hunker down, psychologically until the thing plays out.
What about people who just quit the workforce on their own? What's the effect there?
Well, Terry, that's understandable. We are seeing that. I mean, you do see, there's very little movement in initial jobless claims. They're staying low, but the continuing claims, the people who are exhausting their claims, the people who pass the 6 month mark is always ticking higher month after month over the last 18 to 20 months. So it is undoubtedly the case that it is very, very hard to find a job now. So if you are looking for one, certainly keep the one you have before you let it go.
And I think you've already said that the Iran conflict and the resulting oil price rise due to that conflict does factor into all this, right?
Well, absolutely, Terry. We need to disaggregate two things that might be, in most people's minds, the same thing, which is uncertainty and the oil price are two things. You can get the oil price to go down again and the Strait of Hormuz open, and the uncertainty will stay on for months and months more because people will not really appraise even an open Strait of Hormuz as over because that thing can close again, the conflict can return again. And so this is another thing to understand is we're not just talking about the manifestation of the higher 10-year yield or the higher oil price. We're talking about the long-term track of all this stuff, flaring up again in ways that nobody can see. And that basically, even if you put the Straits of Hormuz open now, it will not clear up the uncertainty.
So, against this backdrop, is there a higher recession probability here in the U.S.? If so, when?
Yeah, okay. Mark Zandi of Moody's does a really good job. He has a team of people who stay on top of this. And as we talk March the 26th, he says this year, or perhaps over the next 12 months, if you want to give 3 months into 2027, there's a 50% chance of a recession in the United States. That's borderline stuff. He's been here before, Terry, last year. He got up there during the tariffing situation and again in the fall. So it seems like the U.S. economy just has enough gas to keep itself sideways. But if we push it too much further from here on the oil price thing into those 150s on Brent for any number of weeks, we're probably going to topple that 50% and go to 60, and then all bets are off and where we're going.
What does this mean for interest rates going forward?
Well, Terry, this is actually the particularly tricky thing in stagflation is stagflation comes out of rising interest rates, so lower bond prices, and falling stock prices. So this is a particular situation where the bond and stock market lose, and so cash is really the only place to hide in this environment.
Is there anything positive in all of this?
Terry, I think the positive is, the thinking that the Iranian government, not the people, has come to a new place, and that the hope of the people who've initiated this conflict upon Iran are going to see some fruition in terms of a more moderate Iranian government, maybe even a democratic one in the next few years. If you think that's pie in the sky, I would remind you all that Syria, of all places, did get itself out of the situation it was in an earlier phase of the same situation. So if it's another Syria, that's really what we can hope for in terms of positives.
On your stock watch currently, three major non U.S. companies ENI, SPA, Mitsubishi Electric, and Societe Generale Group.
Yeah, ENI is worth talking about. This is one of the leading energy players in the world. It's, I think, Italian, Terry. And just to give you an idea of what happened to the stock price here, we were at $37 a share. I'm looking at a $54 a share price for this stock right now in the last 3 months. So astonishing momentum run on a stock like this. And the price earnings ratio is still 11. So we've got a number one rank and an A for value, even at these levels, Terry. So ENI is worth knowing about. I frankly have not seen a spike in a share price like this one, but be careful here. But at least be appraised of what's happened to ENI.
And what about Mitsubishi Electric?
Mitsubishi Electric, ticker MIELY, is in Japan, Terry. Again, here is a Japanese conglomerate. It's got a 32 PE, actually 31 PE. So there's been a big run in Japanese stocks. You might think they're a safe haven, but when I see a 31 PE and a big diversified conglomerate like Mitsubishi, I'm looking the other way. I would be a seller of this, even though the estimate revisions are going up 5% this year and 15% next year. Tickers, Society Generale, ticker SCGLY. We've got a price of $15 a share, Terry. It was about $17 a share a month ago, and it was actually $6 a share a year ago. So a huge run that has seen a massive decline of late because of the worry in the private credit markets we haven't talked about. But there's a lot of pullbacks in banks, and Societe Generale is one of them. Would I be a buyer here? I don't think so, Terry. I think I'd wait it out until there's more stabilization in the price because of that giant run the banks have taken and the risks that are out there with the private credit. And this gets into the nature of this podcast, which is you need all the fundamentals right in a stock like this. But since uncertainty is out there, there's another thing that's not even being penciled into the situation with just this amount of fear, chaos, and uncertainty of what's going to happen to things like private credit, oil prices, American foreign policy, American domestic policy, the midterm election. These are all uncertainties, Terry.
Our chief equity strategist and economist, John Blank, on U.S. policy madness. With John, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.